Susie Orman just brought down the hammer on annuities. Let's take a listen to what she had to say, and then I'll give you my thoughts afterwards.
Can I just do a very quick Susie school on why annuities are so bad?
Go for it.
All right. So Janet put in $50,000 6 years ago. It's now worth $68,300. So in 6 years, it grew $18,300. That happens to be only a 5.4% approximately compounded annual rate of growth, which is horrific.
In today's market.
In the last 6 years. That is horrific. You, Janet, were in an annuity that was an indexed annuity that was indexed according to the Standard & Poor's 500 index. This year alone, it's up almost 30%. Are you kidding me? So, number one, an indexed annuity is not a good investment because you only get a percentage of what the index goes up. You do not get the entire thing. That's number one.
Okay, apparently the real scandal here is that this particular annuity only compounded 5.4% per year over the last 6 years. Compared to the stock market, that's a horrible investment, right? Well, as Susie so often does, she's engaging in a classic apples to oranges comparison. Index annuities were never meant to be a stock market replacement. They're a bond alternative. Although I would make the case that they perform far better than bonds with a lot less risk. Consider the following. The average return on corporate bonds is between 4 and 5%. The average treasury return is between 3 and 4%, and the average return on municipal bonds is 2.12%. So should Janet feel all that badly about her insanely low 5.4% return over that 6-year time frame? Only if the advisor who sold it to her sold it as a stock market alternative. We don't know, and I'd venture to say Susie doesn't know either. In general, if you reach into your portfolio, remove the bonds, and replace them with an index annuity, you'll increase your return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. Let's keep listening.
Number two, Janet, if you decide to surrender this annuity now, then all $18,300 of growth is going to be taxable to you as ordinary income. If you had simply put that $50,000 in a mutual fund, same thing, mutual fund, ETF, whatever it may be, and you wanted to cash out now and it's been 6 years, that would be taxed to you as capital gains. Big, big difference.
Okay, what Janet purchased here is what we call a non-qualified indexed annuity. That means it gets last in, first out treatment for tax purposes. What does that mean? It means she will have to pay tax on the growth before she's able to access the principal tax-free. This is one of the reasons why I personally am not a huge fan of non-qualified annuities. The problem with Susie's analysis here is that in her anti-annuity diatribe, it is not clear that she is referring specifically to non-qualified annuities. The listener is left to believe that all annuities are taxed this way. What Susie doesn't tell you is that you can hold an annuity in an IRA and pay ordinary income. Or you can hold an annuity in your Roth IRA and pay no taxes at all. So once again, I think Susie is playing fast and loose with the facts here. Let's keep going.
Let's just say you decided to keep that annuity. You died, and now it goes down to your beneficiaries. They are going to owe ordinary income tax on anything above that $50,000. In this case, $18,300. If you had that in a mutual fund and you died and they inherited it, guess what? That $18,300 would be non-taxable to them because they would get a step up in cost basis on it.
Once again, Susie is right here, but I have to remind you that she is referring to non-qualified annuities, which again, I'm not a huge fan of. If this were a Roth IRA annuity, that money would pass on to heirs 100% tax-free. But again, financial gurus like Suze Orman don't have the luxury of nuance. They must distill important and at times complicated financial concepts into pithy 10-second sound bites. And any sort of nuanced treatment of retirement strategies flies out the window. Let's keep going if we must.
One thing I also just have to say, KT, if Janet was not 68, let's say she was 57, she's under 59 and a half, and she cashed this out, there would be a 10% federal tax penalty on it, number one.
Again, while Susie is correct, this is true of any retirement plan. Dollars earmarked to retirement accounts generally have a 10% penalty when you access them pre-59.5. Were I Janet, I would never have put my money into a non-qualified annuity. Again, I'm just not a fan. But Susie's explanation, devoid of nuance as it is, leaves you to believe that all annuities should be avoided because of the 10% pre-59.5 penalty. This wouldn't be an issue if this were an IRA annuity. Why? Because all IRAs, whether inside an annuity or out, have the exact same 10% penalty. By not mentioning that this is a non-qualified annuity, Susie has wittingly demonized all forms of annuities, even the IRA and the Roth variety. Let's press on.
Number two is that all annuities in most cases come with a surrender charge, and she could very well still be under a surrender charge of 4, 5, 3%, whatever it is, if she cashes it out before the surrender period is over.
Again, Susie is right that most annuities have surrender charges, but she misses the entire point of why people usually get annuities. It's to get a guaranteed stream of income you can never outlive. You're using it to purge longevity risk from your financial picture. So in that instance, the annuity only really works if you keep it until death do you part. And if that's the case, do you really care if your annuity has a surrender charge? By the way, your 401k has a surrender charge that's far more punitive than any annuity I've ever seen. Full taxation at your highest marginal tax bracket and a 10% penalty if you access prior to 59.5. Not saying you shouldn't have a 401k. You by all means should. I'm just giving you a little perspective. In summary, there's a lot of what Suze Orman says in here that's true, so long as you recognize that she's talking about non-qualified annuities, which I don't particularly like. But by failing to clarify that she's talking about non-qualified annuities, she demonizes all annuities, including IRA annuities and Roth IRA annuities. Furthermore, she fails to acknowledge that the primary reason investors purchase annuities is to have a guaranteed stream of income they can never outlive. I discussed the other problems with Suze Orman's retirement approach in my USA Today national bestseller, The Guru Gap, How America's Financial Gurus Are Leading You Astray and How to Get Back on Track. Buy it on Amazon or wherever you buy books. By the way, in the next 10 years, I'm looking to put 1 million Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. If you have any comments or questions, feel free to drop them into the comment section below. I'll do my very best to respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.